Hi guys, welcome to Accounting Buzz. I am CA Yashika Jain, where we discuss about tax related updates and notifications. So today we'll be talking about section 115BAA, which says that the domestic company has an option to pay tax at 22%. Now this section is different from section 115BAB, which is for domestic companies incorporated after 1st October 2019. They have an option to pay tax at 15%. Now, how is this section different? So, 115BAA says that domestic companies have an option to pay at 22% provided certain conditions are fulfilled. So, one of the conditions which says that any deductions which is available to domestic companies from section 10AA, section 32(1) to A, 32AD, 33AB, 33ABA, 35(1)(2), 35(1)(2)A, 35(1)(3), 35(2)AA, 35(2)AD, 35AD, 35CCC and 35CCD. So these deductions will not be eligible, or these deductions cannot be claimed by a domestic company in case they opt for section 115BAA of 22%. Another deductions which they cannot claim is any unabsorbed losses or unabsorbed depreciation which is there pursuant to these sections, that is from section 10AA to section 35CCD, which I just mentioned. So these any unabsorbed losses or unabsorbed depreciation of past years also cannot be claimed further, so these will be a loss to the company. And further, in case of an amalgamation, if company A amalgamates with company B and the company A has unabsorbed losses and depreciation pursuant to section ranging from section 10AA till section 35CCD, then company B will not be able to claim those unabsorbed losses and depreciation to that extent. Now further it says that normal depreciation under section 32 can be claimed by the company, but depreciation pertaining to 32(1)(2)A, which is the additional depreciation available on plant and machinery, will not be eligible for the company, or they cannot claim the deduction. Now another, it says that whatever is the unabsorbed depreciation or loss, they will be deemed to have been taken. Now a proviso to this clause says that whatever is the unabsorbed depreciation pursuant to section 32(1)(2)A, which is that additional depreciation of plant and machinery, that will be added back to the WDV of the cost of the asset. Now this is only in the Income Tax Act, which will be an addition and not as per the Companies Act. So when I say, let's say I am opting for this scheme to go for AY 2020 and I have an opening WDV as on 1st April 2019 of 100 rupees, and I have an unabsorbed depreciation component which is purely because of section 32(1)(2)A, which is the additional depreciation up to rupees 10. So my new revised WDV will be 110 and I will be claiming depreciation as per the normal provisions on 110. Now a relief which is there is if a unit is there in International Financial Service Center and then they get a deduction under 80L1A, then the companies will continue to get that deduction. Another thing which is there in this section is that if you are claiming or if you are opting for a deduction, or if you are opting for a scheme under 115BAB, which is 15% for manufacturing company, but because of certain conditions you are not able to fulfill all of them, then you can very well opt for this scheme which is of 22% and not 15%. Now another thing that is there in this section is that once you opt for tax computation as per 115BAA, you cannot go back to the normal provisions. So this was it for 115BAA. Do let us know in case of any queries. All the sections that I have mentioned over the course of this video, we will put in the the description box below. Thank you so much for tuning in. See you soon. Bye bye.